All right, guys. Okay, so let's take a look at what happened this morning. First thing that happened, you can see we got our velocity numbers up. Decay pops down right off the open. We get our trapped orders, so we have our first position showing up right here. There it is. Oh, look, it's green. I'm just going to mark it like that, which does show up on the zoom, so you can go check out the zoom. You'll see this happen in real time. It shoots down like that, which gives us probably a stop loss about here. Right, here's the opening low. There's a gap in here, probably sitting about there. And then you come over here and you take a look at at tension, and you can see right there, right about through here. You see not a whole lot of response for a while from these bulls. So we see the bulls come in, they have the liquidity, they have the opportunity to buy into the market, and not much of response with tension. And likely the reason for that was just, who are you going to take out? It's always really good to find a counterparty to wipe out before you start really trying to pump a market in your favor. So looking forward, we could see that velocity came down, gave us another sample right through here. And you can see there's the trapped orders. So I can mark that again. Right there. And then we have a little bit of a switchback coming up, but that's the thing we're looking for, right? This morning, the bulls have the opportunity. They have a couple of things going on here, but they need somebody to take out. They need an opponent before you could pump the market. And you could see that both of these times right through this morning, there wasn't a lot of response on tension. And I think the objective was, well, we need somebody to wipe out. We can't pump a market up. Otherwise, you're paying all the money yourself. And we have a little bit of a switchback, and you can see pops up there. We have some trapped orders, and that's basically, it's pretty clear that's what the market was waiting for, looking for some bears to trap out of their position. I'm gonna do a little lighter there. There we go. So we can see the bears right here, and their stop, their stop is probably going to be just up here. Here's the pivot. You can see here's a high here, so probably right about there on the other side of there's a good spot. And you can see the market immediately pumps up right there. The bears, as soon as they fill an order, the bulls press the market up. And at this point, right about here, I think it's pretty clear what's going on. The bulls were waiting like predators for the bears to come in and fill a position. That's what they did. As soon as they did something, it was push the market up against that bearish position. Now you can see right here, the market comes back up. We have it crossing over zero. So we have a position here. This is the bears I'm marking. Crosses up right here. And you can see this is the trapped orders. For that, the red comes in. Well, I'm going to duplicate this one so I don't have to change the color. Right there. And again, the idea is what's going on in the market. And I think it became pretty clear that the bulls were just waiting for bears to come in. And this looks like a bleed type of structure where it's just going to bleed up every time the bears find something. We just bleed the market against them. But again, they pop in, and there's not really a whole lot of great spots here. So probably just, up above the market is where you put it. And that was it. They came in, they filled, they finished up. The market dips back down here. We get trapped orders again, and the bulls do it again. So we have sort of a behavior or a pattern that's going on here, which is, the bulls waited, they push them out. Then the bears come in first, and they come in, they push them out. It's the same thing that happens every day. The bulls wiping out the bears this morning, they did a great job. And you could see that the bears didn't really do a great job through here when it comes to impacting tension. The bulls have dominated tension all morning. The bears just got wrecked twice. So moving up higher, you can see that, again, we have it gets a little noisy in here, but pops up. We have some trapped orders. I mean, there's a couple of positions, but I think at this point, it's like, well, I think the bears, getting wrecked. Do they really want to be in this market? And you can see right here, the bulls finally get a little bit of a, you know, in this indicator, when you're looking at this, it looks for it to kind of pop, like if this is 0 line here, it looks for it to pop up for a second before it comes down. It's not going to accept a single bar of above. That's going to create this type of signal. But this one, it looks like it popped up for a bar or two and then dipped back down again. And, you know, right up here, we have this position. So we have this color going on here, which is that the bears are bleeding, the bulls are just hitting and hitting and hitting and hitting. Now the problem that you run into in this type of market is that if you consistently beat up one side of the market, they get discouraged. They stop wanting to participate. So the thing you watch for while that you have these little parts that blast up to take out stops is you keep your eye on tension. We see this a lot. You want to see tension accelerate upward, and that's going to show you where that people are dumping their position. So looking at this, we have a little bit right there. You see that little notch popped up right up here. I know it's not much, but if you're watching this in real time, you've seen tension curl up a little bit there, and that little curl is going to let you know a lot of people dumped their positions. So this little notch. Now, I don't zoom in on this chart because if you're zooming in on tension, you're looking at it too closely. It should be something that you can see generally. I don't get that close to it. If you're getting too close to it, you're gonna start seeing a lot of things that I think you're getting too much detail. You look for what you're expecting, not for what you see. Expect it first, then you see it. So we get up to these highs. You see this little bit of acceleration right there, which is a lot of these positions all getting knocked out. These guys, I think, got knocked out about here, but people will have dropped a couple positions on the way up, but that little acceleration tells us that it's market-wide. There was buying and accelerate, and that buying, we can see who that came from. It was the bears who got knocked out, and that happens to correlate with this right here. If it kept going, I would still see the same thing. This isn't because of the highs. That little notch right there is what I'm looking for. It's really important that you know that when you see markets like this that start bleeding up, where every time a bear comes in, they get wrecked, you start saying, well, how far up is this going to go? And you start looking at tension for an acceleration. I think it's pretty straightforward. We get that. Then the next question is, can we rinse and repeat? Can we put the market into a situation where that we can trap in some bears again and continue this higher? Or you need another mechanism. It's a big deal that you know what mechanism you're using to drive prices. If you can't point to what you're using, that's a big deal. You should be very careful if you don't understand the mechanism that's driving the market up. And in this market, we have these people from this morning, but you know, since they dumped a lot of their positions. Now what I'm doing is I'm going to pull up, I was looking at Caro. Did you guys see Caro? It was supposed to IPO today. I don't know, it's not showing. Thinkorswim's got this weird lag, but Caro I thought was a fun name. I'm gonna pull up the tick, which is one of the tools that I look for in inversions, and Thinkorswim's gonna take a little while today because I have a ton of stuff running. So we can look for inversions. Inversions are where you have the tick, which is an oscillator, push up and give you a high, and then you have the SPY or ES going like this, and then at that same point, you have like this type of thing. And I call this an inversion because it's costing less ticks to drive price up higher. So I'm going to look for a tick inversion. If you've been paying attention to this strategy, that you should be like, this is the same thing you do every day. It's because the market does pretty much the same thing every single day. It's still loading. But I could see that we're at 22, so there's we'll see. Anyway, so I'm going to look for an inversion through here. That's the next thing. You can see right here, decay pushed up, and we have trapped orders right there. Now, the reason I'm not looking at this one is because this hook right here, I think, had to do with people buying out. This red is buy orders coming in. You know, you sell against buyers, a buyer against sellers, so I think that it's red because people were buying out. They were dumping their position. So I'm looking at this one right here, the next spot. So I'm giving you the step-by-step. I just skipped over. So I just skipped over looking for a tick inversion. So I'm going to come back to that because the chart's still loading. But that's the next thing I'm looking at while this is rising and we see a blow off like that. I look to see if there's a tick inversion to see if we're going to continue or how far back it could pull back, stuff like that. So we'll come back to that in a second once it gets loaded. So we see decay pops over. Here are our bears, and then it leans back, and you can see velocity stays away. So you can't see, none of this happened here. It's right here. We get right to the lows. There is our bulls. Okay, so the question here is, can the bulls continue this higher? Can they continue to pump the market or not? And in order for the bulls to pump the market higher, they're going to need to trap somebody in or have a running inversion. Those are the two mechanisms that bulls typically use in a market like this. So at this point, they're going to need to find some bears to pull into the backside of the trade. And we could look to see where the bears are. And this ends up becoming, well, it's not too bad because we do have some here. But we could figure out where that they are by looking at where we would have to go to find bears. Now, one of the problems here is that any move down is going to result in a bullish sample. That's an issue. So to get to any bearish liquidity, the market's going to have to go through bullish liquidity. And that makes it kind of unattractive to the bears. They're going to go, well, how do we get into this market? How do we get some footing in here? If you sell, if you ask for liquidity and you sell the market right now, you're going to push the market into the hands of the bulls who are going to want to push it and roll over your position. And that makes it kind of unattractive to do. I wouldn't want to do it. So I think that the bears are going to have a hard time wanting to push this down at this point. There is an operating position right here off the highs. That is so great for the bears because they love to operate from extremes, or at least really close to the extremes. Like this morning, these bulls, I think, are close enough to this extreme. They like to trade from daily extremes. Why? I don't know, an ego thing maybe? I don't really think there's an actual reason for it at an institutional level to be at a higher low, other than it's just kind of nice to be at a higher or low. It makes you look good, you feel good, you're like, yeah, guys, I bought the high and the low, and boy, do they love the water cooler like statements like that. They love to do that at the institutional level, which is interesting because retailers do that too at the Twitter level, and I guess everybody just loves to do that. Okay, I'm gonna get rid of this. All right, here we go. So let me switch over to this screen. So we got the rollover lines. Here it is. Okay. So we could see the high was right here off the open in the first hour on the 935 bar. So come over here, check 935. Right here. So our inversion level is literally here. That's where we inverted from. I'm going to change this to yellow. There. This is our inversion for the day. It's still in play as long as this high stays unbroken. You can see a couple of pushes up, but none of them actually broke it. So we just need a push, Pat. That's easy. 852, that's easy. That's easy to do. That's not a super high inversion, but nonetheless, it's in place. Why is this important? It's because I look at this as the cost of ticks. If you get all of the stocks to tick up in the New York Stock Exchange, or a lot of them, you get a surplus of upticks and you get the tick to move up. So essentially, if you are an institution and you cause all stocks to uptick at the same time, the tick would shoot through the roof. So it's sort of like expensive to get the tick to move up because everybody has to move in conjunction at the same time. Now, if you're sitting there hitting stocks at different times, like every couple, it's like, I think this is every 1/32 they calculate this. So as long as you're doing it, every second or something, it won't show up really on the tick because it won't calculate it. But if you're doing it all at the same time, you put out a huge order all at the same moment, tick is going to shoot up. So this looks to me like how expensive it is to buy into the market. And this morning, it cost the most at like 875-ish. And so far, we haven't seen that kind of consolidated effort. And usually at the beginning of an inversion, you have a high tick and then it pushes up and it breaks. And then that consolidated effort lines up with the moment where the market will sort of stop and give us a little bit of a pullback and decide whether it wants to continue or reverse. So I'm waiting for that. And that is way down here. So we have a lot of room to play around. The other thing the market will like to do is it looks for the root position or the best position off the day. And the bulls are right here, the bears first position, everybody sort of lined up right here on the inversion level. So I'm sitting here going, it seems like the best place if the market was going to pull back to would be there, but that would retrace the whole day and could create a headache for the bulls. So I don't know if the bulls really want that. I don't know if the bulls want to see this come down to here. The other thing would be is if we came down, we're going to have the gappers come in, and gappers are just okay, go. They don't need reasons. So our possibility space right now at this moment is that the market could come down and possibly test this morning's positions. But I don't think that's in the best interest of the bulls. I don't think the bulls want the market to do that. So I don't anticipate it. I think the most reasonable thing is for the market to sort of fiddle around here and try and get more people like this into the market. We need more sellers, more people trapped, just anyone we can get. And then, I don't know, and then give a concerted effort up a little bit higher, go for their stops, maybe 39.85-ish, we'll say. Knock out this group if possible, and then take a look at where the market is there. Now, the reason that I think that makes a lot of sense is taking a look at tension. We could do this for a whole nother day. This absolutely, and get us up to negative 60% tension. We could do this for another day. No problem. We have daily tension flipped up here. The bears gave a little bit of defense, but at the end of the day, didn't get daily tension back. They lost it right here. So I don't think the bears are like really enthusiastic at this point. I think they got really demeaned this morning. I think the bulls are excited about this, but at these levels, I think the thing that is causing the most grief, are you ready? The thing I think that's causing the most grief is this number. 4,000. I think the market is looking at 4,000 and going, that's a big number. Just people do that. I don't know why. Like we'll sit and look at 4,000 and it's so 4,000 or 400 on the SPY. That's such a big deal. We need to throw a huge celebratory party, and we care about these nice big round numbers. And I think that's the thing that is really irritating people the most. It's that we're getting just real close to pushing through to the 4,000s, and then we're going to be hanging out, and then we'll start to look at, instead of in the 300s or the 300s for SPY and the 3,000s for that ES, we're in the 400s and the 4,000s. I don't know why that matters, but I've noticed through the years that I'll even do that. I'll be like, are we in the 1,000s? I still remember when the ES was in 1,800. It was in the 1,000s and then the 2,000s, and now it's the 3,000s and then the 4,000s. And it's like it takes this big mental shift where that you think about the number. I don't know. Maybe I'm insane. I don't know. But this is something I think that matters to the market. It's the big, nice 4,000 number. We got here relatively quickly. At least it feels relatively quickly to me, from the amount of time it took to get from the 1,000s to the 2,000s to the 3,000s. From 3 to 4 seems like it went pretty fast. And maybe that's just me. Maybe I'm the only one who thinks that, but it kind of feels like we got here quickly. And I think that's what's giving the market grief right now. I think that's a really dumb thing that rich people care about. Numbers. So we have to figure out how to make this happen right now. These bulls, who I think are probably holding a majority of their position here and here, and a huge chunk here, are trying to figure out the best way to get us through till tomorrow. The options that the bears have, they could get an elastic market. That's a possibility. An elastic market is where the bears step out of, an elastic market is where the controlling party, I'm going to just say CP because I don't want, the controlling party moves out of the way. They move out of the way. Why would they do that? Well, usually it's because tension is too high, like something like this, where that you're sitting there going, this is a little hot. And so the controlling party will move out of the way temporarily to let the counterparty blow off the steam. The hot, it's too high. But 21, that's not that hot. It's not hot enough that it's, and the way that you gauge this is, could we continue? Yeah, we got lots and lots of room to run. So there's no good reason for the market to need to cool off. The bulls don't need it. We could do this tomorrow. Could they move out of the way? Yes. So it's totally possible. The way that'll look is we get a bullish sample, like something like this, and they do nothing. And the doing nothing is a sample where you get a crossover, either velocity or decay. Then you get trapped orders, and then you see the price response is maybe not amazing, and then tension, not really. Well, in this market, it would just go sideways, and you'd say the bulls did nothing. They had liquidity. They could have piled in and driven this up higher, and they chose to do nothing. That's a nod. A nod is a non-verbal agreement between counterparties, which would typically be considered a federal offense to, talk about this. And you can't make deals like this as major institutions. You sell, then I'll buy and push things around. It's just not legal. But because it's non-verbal, a nod like this, you can't, nobody's at fault. So the bulls will move out of the way. Then the bears will get excited. So let's say this gives us a sample. They do nothing. The market will want to find some bears. So plus for bulls, minus for bears. And then the bears will want to drive it down. That would be the nod. They could get an elastic market. I think 22%, negative 22% is just not enough. It's not enough to even consider that. Right? It's not hot enough. Maybe if it was 40 or 50, 40% maybe right here, and then say, well, tomorrow if you did this, it'll be all the way up to 70%, which is really, this is as high as we usually see it. See what I'm saying? So I don't think down makes sense here. I just don't. I don't think that an elastic market makes sense. I think the market wants to churn people into their positions. They want to do what I call emotional, I think it's an I. Emotional inoculation. They want to get you, if you're short, they want you to get really emotionally invested in that short. If you're long, they want you just totally concerned about it. And basically these ranges that happen where you see a market that sort of shoots up and then goes sideways, the amount of time that happens inside of this range is equal to the emotional entrenchment that you have, how stuck you are, how convicted you are. And it's this conviction that ends up destroying you. So if you're short maybe from here, let's just hypothetically, if you were short from here and the market comes down and bounces off the back of your position, your stop loss could be here. And what happens is because this range is so, from T0, from when you started to Tn, it gets you so entrenched in your position that you end up taking your stop and scooting it way up. And you make the fundamental error of day traders, which is that the stop loss equals the profit potential. And this is where we are. We are at the point where the market is inoculating the bears in order to determine if we can get their stops to move higher. And the bears will say, well, my profit potential is all the way down here, so I'll move my stop loss up here, and I'm in a trade that's a 1 to 2. That's so great. One point per 2 point profits. And it's like 1 point loss. And this is just dumb because you're already in the position. Your risk reward was defined when you opened the position, not now. So you're just getting convinced to move it wider. So your eyeballs tend to dart down to could go here, could go here, could go, and you pick the lowest one and you say, that's my max profit potential. Oh my gosh, that means I can justify a wider stop. And the whole point here is just to get you to move your stop higher. That's it. It wasn't to open up more profits. It was to get you to move your stop higher. So these inoculation ranges, which I think this looks more like an inoculation range, get you to move your stop. So you lose more. And what ends up happening is your broker, your broker is going to institute some margin call. I'm assuming this chart continues higher is what I'm doing. A margin call level like here. And the goal is to get you to put your stop above it. Because if we could get you into margin call territory, then your broker can take your position and close you at their client. So you're the product. So, if their client's here, they're going to margin call you there. It's not about maximizing their profits. It's fulfilling a client. They do get some money there, but they have some client here. So if they can get your stop above your margin call, then we can push it up, and then they get the ability to decide when you close. And they're going to close you to the highest bidding client. That's what they're going to do. So that's the objective. Hopefully nobody is even close to your margin call and you just aren't even operating in that mindset ever. Nonetheless, that's the goal, is to get your stop over your margin call so they can give your order directly to a client and enjoy the money that comes with that. Okay, so we're getting a dip here. This is crossing over and we're getting trapped orders as a response and they're almost finished. We're going to have another bullish sample, and we'll get to take a look at those bulls, and we have this nice inoculation range to take a look at. We can see there are some bears at the top who potentially enjoyed some profits on the way down, just being opportunists and seeing the market sort of got blown out a little bit. I don't think they're going to win. I think they're going to get wrecked by the close, is what I think. We're just waiting for this to finish up. And then we can mark out where that bullish position is. I'm just waiting. Well, this bar is taking a minute, so let's take a look at the volume profile. I thought this was interesting, is today, a lot of times on a rally, you see it break above the profile and sit above it. And today it tried to break above it, having a hard time staying above it until right here. So we didn't really break out today. It was just widening. There was a ton of volume. If we had seen the value area stay here and then pop up, you see point of control wasn't the culprit here. The point of control sat flat. It was just widening because there was lots of volume all the way up. So we have these nice low volume nodes showing up that you can easily mark out. And you can see we got right to one of them. Sorry, these lines are not super straight. But the thing here is that we were staying inside of the value area, which is really hard to see that if you don't have a developing volume profile. Otherwise, you just see a level here and you have no idea. There was just lots of volume that came in. And then we finally broke above it and we got ourselves an expansion, which expansions do love to retrace themselves. We just don't know when. That's important. There was a lot of volume. This was not a regular just like blow off up to the top, which it might look like. This looks like a ton of volume came in. It started to fill and pushed that volume area wider. You'd see the lower, it was just a ton of orders. That's what this looks like to me. So yeah, we're back into the value area, but it's not like we have this huge just explosion. It didn't work that way. So lots of volume came in. There was more and more volume. whoops, that's at higher and higher prices. We did have that. And the volume profile is all about determining if there was more and more volume at further and further prices, up or down. In this instance, there was more and more volume at further and further prices. So that's supportive, not the other way. I think this is supportive for the market. That's good to see a bunch of orders come in as the market takes off directionally. That's really helpful to see for today. We have these two low volume nodes. So these are going to be something you're going to want to pay attention to. If you have a volume profile for just today, they should show up on there, on any volume profile. Looking at the options, oh, we have this. This is done. So we'll mark it out right there. Where would the stops be on this? Well, you got to be a little careful. So we have what I think is the origin here for this whole situation. This is going to be a root or a secondary position, and this will be the secondary. So our root here is our first one. It's the lowest position intraday above the origin, which started, pullback, go. So our origin is right down there. Here's our root. It's the first one, and this is a secondary. You have to be careful about secondaries because secondaries like to have teeth. So keep that in mind. Teeth is where that you come down, you have a signal, and then the market dives a little bit before moving favorably if it's going to continue. So you have to be careful of teeth in secondary positions. That's a big deal. But because of the way the market's configured right here, we got ourselves a position here. We had a little bit of some teeth going on, not much. We have some support here. I think this is good. I think that the market should continue and take these guys out by the close. But you do need to be mindful of teeth. If you're holding a position from like here and you saw this happen and you're like, cool, and you bought in, you might just toss a break even on this and say, I think that maybe some teeth could come in and scare me, but I think the market's got upside potential. I think that's a reasonable thing to say in this condition. But if you're buying in here and you're trying to hold on to this, you may need to consider this has the potential to give me teeth. So after a position, you see it dive, goes for some stops, looks to retest old trapped out positions, the losers, which we kind of got that one there. And then they have this next one here. You need to be aware of teeth if you got in here. Otherwise, with like 45 minutes left, we have enough time to do a couple things, right? We could dive a little before moving up. Could just shoot up though. Shoot higher. Taking a look here at the tick, still nothing. Hasn't, like all market. All markets is a little easier to see. Still hasn't breached that level. Let's see if we can shoot it to the right. There we go. Now let's take a look at the options. One of the things that I've been looking for a lot with the options volume, this is SPX options, remember, is hedging the major position. So like off the low or something, or off the root position. You can see right in here, this is about where that we had those bulls who came in with the inversion. So what you want to see is, did they get a long position that was profitable, and then hedge it with a put or something. And the puts that I look for those is the OTM, an OTM put. That's what I want to see, an out of the money put that's going to hedge this. And I don't see any puts up here. So I don't think that long has been hedged with options. Now I know, you might say, oh, well, they hedge, your broker and stuff like that are going to hedge their positions with the futures. Okay, fine, that's fine. But the thing that I look for, because it's been pretty consistent, is looking for a large hedge that hedges out some low or high or something like that. I'm not looking for any calls that would hedge like these because the market's been rising today.
If you leave them alone, they'll stay down.
Like that. We're not going down, so I'm not super interested in that, but we could, because of the high, we did have some positioning in the highs. We could see some calls come in. You know, this is a smaller position. Usually it's like 1,000 or something like that that will hedge, but we could see a little bit of that. Mostly, I like to see something real obvious, but not. The only thing I've really noticed today is that this morning we had a lot of call activity, and then is
There.
okay. You just gotta wait. The kitty cat will come back and play with you, buddy. Okay. We saw some call activity this morning, and then the put activity went up a lot here, but there was still some call. It's kind of like maybe these two things are related, you know, some calls and then some puts. I'm not sure because it's just not clear cut. There was a little bit popping in here, and then it sort of cooled off a little bit. So mostly this morning we had a ton of call activity. It was pretty clear there. And then mixture, but it does look to me like there was some put. So I'm wondering if there was some positions, maybe these guys or something, they're hedged against each other to try and get into a fancy option position that helps you mitigate some risk. I don't really know. It's not super obvious to me, but that's something that I did notice. Otherwise, I don't have anybody hedging the lows out yet. So our lows are still wide open to risk. These guys here, if the market plummets, are not hedged. They do not have puts yet, as far as I can tell, against these positions that are going to capture in some profits and allow them to operate in the future. They're wide open. So if this plummeted, these guys would need to absolutely dump, which that's important because if price comes down to here, if this position is hedged, it's risk neutral, which is a big issue. Price is not going to come down here if there's no risk to destroy. I still don't think it's going to happen. I just need to point this out. If the lows get risk neutral, it makes those lows supportive. If they're not risk neutral, they're polarized, they're one way or the other, then that can look good. One of the things you can do is if you're in a long position and you're a big institution, main player, you just penned a bunch of positions right here. And you're basically saying to the market, if you move down, I'll fill a hedge position right here and make the lows risk neutral, which means that it'll pop back up. It's sort of an if-then statement. You could do that. I personally, if you're a huge thing and you understand the market is based on commissions, then you penned your hedge up here and you say, well, if you come up here, I'll pay you. And the market's like, oh yeah, well, let's go up there. And you just penned 2,000, 8,000 contracts up there in the options world. And then if the market's going to get pulled up to want to fill that to get commissions for the exchange. So it makes a lot of sense to pend up there. That makes perfect sense. So I think that's the more sensible thing to do. So I think what I'm watching for, you know, if we get this to pop up, which it won't look that aggressive. If we get that to pop up, I'll zoom in a little bit. See, boop. And then we get some puts to come in, and then they start filling when we get, I'm going to say, hey, you guys were penning positions against your major, the longs off the lows. I think that you suckered the market up to fill those, and now we have a risk neutral low. So that's what I'm thinking that these guys are doing. They're waiting for something a little bit better. We don't have enough to go elastic here, so the market's probably not going to be moving lower. If the bears run an algorithm here, I think they're going to run into some issues. The bulls are going to pick that up. They don't have anything left over here. I think these all got wiped out. The bearish positions did. We do have an operating bear from here. So is it likely that the bears are going to run an algo? I don't think they should. I don't think they should run this down to here. I think what the bears should do is step back and say to themselves, this is what the bears should do if you're a bear. Well, if we sell here and this goes like that, we're screwed. So how can we sell here? If I was a bear, that's what I'd be. I was saying, how can we get this market to that point as quickly as possible so we can get into the market? Because 22 is weak sauce. It's pathetic. You don't want to be trying to bearish a market at 22. The bulls could come in and just dominate. So I think that that's the most reasonable thing. How quickly can we get this up to these higher levels? You know, if we get it to negative 60% or something like that, even 50% you could totally have seen elasticity from 50%, but 22 is stupid. You could get just rolled over. So my expectation is to see that. I expect the bears to step back on a major way. They should step back and say, let's pend up a bunch higher. Maybe we could help. Is there a way we could help? Let's call our friends and give them bad information. Maybe we could screw over another institution, and while they're getting screwed, we'll get better prices. I think that's a very reasonable institutional behavior. We just have Merrill Lynch is Morgan Stanley call up the traders from, I don't know, a hedge fund and say, hey, we got insider information, the market's going to tank. Is that predatory? Of course it is, but that's the market. So that's kind of what I'm thinking right here. I think the bears should step back. I don't think they should try and run out. Oh, it's another one of these. I don't think they should try to run an algo. Now, if they do, I think most likely they'll get this down to about this level. They'll be putting pressure on this guy here. A lot of people are going to dump their longs because of the teeth. That'll create a bullish position, and then the market will pop back up, and all the cash the bears put into an algorithm gets converted into risk exposure. So I don't know. If I was doing, I wouldn't do that. I wouldn't run an algorithm and flicker the bid and the ask across the stocks. I wouldn't do that because it's too much capital to get almost no returns. When it comes to capital, your return on investment, you're going to be putting like millions and millions of dollars into your algorithm and make, okay, say here, 8 points. Really? I wouldn't do it. So I think it doesn't make sense for them to do it. Could they run an algorithm? Yes, absolutely. They can do whatever they want. But you need to understand the limitations here. Now, if I were going to run an algorithm, let's just say I am bearish, what would I be targeting? Well, I'd be targeting this, the fact that the lows are not hedged. So remember, your algo needs to go not down to there. You need to get it down through 396 at least. So you're going to be looking, what? 3960. That's a big fat, almost, I mean, you're basically going to be running a 20-point algo, which is enormous. That's like the news event it would take to justify that type of an algo is going to have to be pretty big. And I don't know, perhaps there's something in the queue, in the news queue. Hey, none of that. But I don't know. I just don't think it's sensible. There's just too much range here to get down through there. I'm keeping my eye over here on this. I want to see some puts come in that are going to hedge out those lows. And at that point, the market's going to say, well, it doesn't even make sense to go down. It just makes sense to churn these people and eventually pop higher. That's the... Hey, why don't you go do something else and the kitty will come find you? Pierce. Hey, go on. He'll come find you if he thinks you're doing something fun. So go do something fun. So my expectation is Aditya Rayo. How do I identify the origin? Origin positions, the question I got here, origin positions are the ones that are major pivots. So it takes, hey, can you go do something else? I will answer your question in a minute. I'm going to get him going on something. I'll be right back. Okay, origin position. This Stream Deck drives me nuts sometimes. Does this. Oh, I can't pick it up. The wires are too... It just shuts off. It's got like a static discharge issue. Anyway, so an origin is going to be a position that controls a major move. And the reason I picked this as an origin, you can see that this got burned all the way off, and then tension started to rise through here. That's how I picked out this as the origin position for this move. But in essence, it is typically a difficult and major low that gets created, and then the market operates from that low for the next couple of days or weeks. And this one you could see up, 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 pull back, up, 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 and it's just sort of, I mean, I just eyeball in that section. And then looking at tension, you could see the burn off on this day, and then we're reset into our up right through here. And that's just generally how I pick out the origin. It's just the major pivots that I see. And in real time, they're usually, I mean, you get these situations where you're like, oh, well, the bears are coming in. The bears, as you start thinking a little bit more bearish, and then you get this bullish position that just won't fail. I've lost my Stream Deck. I cannot switch anything. Just a second. I'm going to do something. Okay, turn it off and turn it back on. Problem solved. So you get into this bearish mode that you're looking at these numbers and you're seeing things turning bearish. And then it's the major bullish position that turns things around. And that's essentially the way I pick out an origin. But if you don't want to pick into the nitty gritty, you can usually see an origin as just the major pivot points. So here, and then I came over here and you could see there was this spilled off. We got bulls getting a sample through here, and then the market pushed up, gave us a second sample, and it was sort of toothy right there. And then these guys dropped their position here, giving it to these guys who are bullish, and that is what set up the lows. This was a tough low. If you weren't looking to buy, you would definitely not have bought this low. And so the difficulty here, origins are typically difficult. They're rough. And if you're not expecting or anticipating them, usually tough to trade. But then once you see it, you could say, okay, this is our origin. And then usually an origin position, which I haven't actually shown this. We come over here. A lot of times the origin positions will get edged. Let's see if we can get up here. There we go. So we have a couple, not a ton, but you can see a couple right here. So here's the origin, not looking backwards, looking forwards. Come up. Here's an in the money. So there's the put. You're going to pay. Here's your premium. Here's your strike. And that premium should be above there. We have a couple of other in the money puts that are not edged, obviously, with. So we could see that this was at least partially insured, which means that it's risk neutral. So blasting through this low would be very difficult because there's nobody losing money on this side. So who's going to pay? So markets really don't like insured lows, or at least to blast through them because of the insurance problem. So a couple of the features of the origin positions, they're just something that you track, you see the lows show up, you mark them out. But generally, it's just the major pivot turning points. You could look at this as a root position, and you'd say here, somewhere down here would be the origin somewhere, and this would be, you can do that. The reason that I wouldn't look at that this way is because we had a little bit of a pretty decent reset right here with tension. Otherwise I would have called this a root. That's the big thing that I picked. I don't know if that answers a little bit of a ramble, but that's how I pick that out. And then once you have a root position or an origin, which my head is in the way right there. Sorry. So here's the long, and then it came down. There was another long. There's decay, decay. They would have given up. A lot of people dumped their positions to this there, and then it got held, and you can see we came back and even tried to test it, but yeah, didn't quite work. Then once you have an origin, you can start looking at things as the next root position, and then you start to see things like this, and you call that a secondary to the root. And then you start being concerned about teeth. And one of the things you could do if you're looking for teeth is to position accordingly. So you get sample and then you say, well, if this is a position, well, I'm going to pend a long down here, and you wait for it to dip down to buy into it instead of buying right on it. That's a tough thing to do because it takes some serious discipline, but it's an effective strategy. As long as you can define when that you're in a secondary versus a root versus an origin, these are the easiest to pick out because you've already defined these things, or, you know, because historically it's easier to look back and see what's obviously the origin of the roots. And I think that's why that they do this, is because they're a little easier to define. But once you see those types of things and you can define them as a secondary or whatever, you can position accordingly. You say, well, where's the position? Where would some stops be? And just limit into the stops. That would be the way I would operate with this. But the best way to operate, just to be very clear here, is to try and get into the major roots and origin positions, not the secondaries. They're harder to trade because they take a lot. Like if you were to take this and you would have like a needle here that went, you know, along a spectrum. You had over here a lot of conceptual versus risk. You'll see that at these origins and stuff, you're a lot more conceptual. You get more ideas, things like, well, this doesn't make sense. We have this, and it's these ideas that build up a lot to build the lows. As you get into like things like the secondaries and stuff, you get a lot more on the risk side, where that you're looking at where your stops are, where the positions are. And you've heard me talk a lot about, oh, well, it doesn't make sense. The bears could get blown out because this could continue. It's a lot more risk focused, while that at the origins, a lot more concepts like, well, the bears are exhausted. This is their victory lap. There's some other things that come up. And that I've noticed that's pretty consistent. At the roots and origins, you're a little more conceptual about why you're buying in. There's a lot of other things too, but from this analysis, I get more conceptual about those roots and stuff. The secondaries are more risk-based. And I think that's why they are toothy. They tend to press the risk because that tends to be the motivator for getting into a secondary, is risk models. Okay, so our last half hour here. What to expect? Well, again, I think that this position popped in. These guys right here, the bears, and I don't think that they were justified in doing so. So this is a position that's in the crosshairs of the bulls. The bulls have lots of positions today. So far, we haven't really seen much pressure. So within this last little space here, I would love to see an insurance policy is what I would love. Just that. Just one. Oh, we do have a little bit. Oh, why? I didn't see this. Here's one, 300. There's 250. Why didn't I see these before? What am I? Are they there? Pretty sure they were. I just didn't see them because I had it scaled like this. Okay, so we do have a little bit. I like the thousands. I mean, look at these 2,000, 2,000, 1,000. So there's a little bit. That's good to know. That's good to know. I did not see those because of the way. I'm gonna have to remember that that'll get me. Okay, so there are some insurance policies. I need to learn to read my own indicators. Here and here, that is going to make this section right here. Remember, not the open, the bullish position right here. It's going to mean these are risk neutral. We see this a lot, and one of the things you have to remember with risk neutral means that in order to blow through a risk neutral low, you need to find somebody else. So usually on the way down, you'd want to find a bull or something, a major position. to drive this lower is the deal. You can't just run through those lows. Otherwise, you get stuff like we had. Oh, that's the wrong button here. This one. You get lows like this where they try to blast through a risk neutral low and you just get completely rejected. And that's what would happen right now if an algorithm attempted to run the lows. We do have some hedging, so that's a good thing. Got some hedging. Otherwise, if we move the market down into the close, that just gives bulls an advantage because that would probably keep tension from going any further into the close at all. So it probably will close something like negative 24% at this point. And moving the market down is just going to give them a little bit more favor. But I don't think that is going to topple the bullish position. So an algo down to here, I'm going to mark this. Okay, and I'll go down to this level. Stops right about here. It's under that line. I don't think it's going to challenge the bullish supremacy here. So it will shake out a lot of weak hands. Oh, got to turn this off. All right, I'm taking a look over here at this market, or these other markets, not the value.
I can't hear you with that up. I can't hear you, Daddy.
They can hear me, see? Still on.
I see.
Okay, go do what you were doing. So looking at this, I don't think they'll be able to pull it off with an algo. They might try. We'll see. I don't think that a bearish algo at this point is going to be a super good play. I think a bearish algo would expose that capital to risk, but nonetheless, they're going to do what they're going to do. It will get toothy for these guys, so they're going to have their stops probably here when they have to put them down here. The problem with a secondary is that you need to share stops with the root position, and that typically gives you horrific risk reward. And so it's just a second. This little bit, I'm looking at my mic meters. Okay. All right. So I think a push down. Yeah, this is toothy on the secondary position, but I don't think incredibly practical. Buffering. Sorry if you guys are getting buffering. I have no idea why you're getting buffering. We are getting this came down. We have a crossover. Now, when it comes to signals, I like to see the cross first, the zero test first, and then volume. So I don't like to see the volume into the test. I like to see the test and then the people knee-jerking to the response. So they're going to say, oh, there's the test, and then you get like the response to that test. So we're going to have to sit and wait for the volume to show up on this. Couple of options over here. Oh, was I looking at that? Right here. There's the test. So we're waiting for that volume to show up, and I think that these guys are getting pressured. So this is our toothy market. We're at the bulls get their secondary, and the market comes down and pressures that secondary position. Like we realized earlier, sorry, I totally jacked that up, but we have a little bit of insurance that came in to insure the lows. So I don't know that 550 options contract is going to fully hedge the lows, but I do think it's going to create some risk neutrality, making the lows a little bit more resilient. Not outright just risk neutral though. Look at that. 100 here, so maybe they're insuring a little bit. This looks like a range behavior to me. Our second low volume node is right about here. I expect that to line up pretty good with this level right there with the bears' second position that they took. Looking at this, 73. So right in here, about 70, maybe 71, 39.71. I'm not entirely certain. I don't know that I feel like the bulls are super confident, as they didn't do what they typically do, which is get a huge risk hedge. This is typical in a secondary position to see the teeth. You get the position is up, you get a pressure on it before that things can happen. So this typical behavior, we push down to one of the main positions. I don't know if this one makes a whole lot of sense since there is some risk neutrality going on here. That's our inversion level. So look at that. We got right to our spot. Some response. Let's see how far up. Now, if the bulls are going to continue to pump this tomorrow, I think a bounce would make sense here. I think I say bounce to invoke the idea that it happens quickly and immediate for a reason, because getting this to move down here took capital, bearish capital. And if the market sits and hovers around and doesn't do much, it gives this capital the opportunity to get pulled back out of the market and not be at risk. If the market pops this back up, we can trap in the capital used to run the algorithms to push the market down. And that capital that got put at risk can be used to help fuel the market further for the bulls, who I think are still sitting here and here. I think these are their two, most of their positions here, but I think these are the ones that I care about the most because they immediately knocked out their opponents. And then it was a little messier from there. So those are the ones I'm watching. So I think that this should quickly move up if they want to capture that capital that was used as an algorithm. Now, one of the things I don't like right now, especially, is that we have a zero test and a zero test, and we're still not getting trapped orders coming in here. What that sort of looks like to me is, hey, we gave the retail market a signal. Why aren't they jumping on board? Where are they? They're not convinced for some reason. These guys are not convinced. Okay, so here comes some volume. So it's a little messy. It took them a minute to show up, but they're finally showing. I like to see the retail market be very hair triggered. As soon as we get momentum to go from positive to negative, they immediately are like, oh my goodness, right here. And they just start trying to trade it just as quickly as they can, because positive means up and negative means down, and the world is flat. So I like to see that. This took a minute. Okay, fine. Not as hair triggered as I like, but that's okay. We're getting the liquidity needed here. 15 minutes left. We're going to run into some problems like the national best bid and offer getting shut off as a requirement so people can do stuff, and I don't like that happening right here. Let's see. We're at 71. So I'm looking over here at this, seeing this, the LVN, thinking, you know, an algo got us down to the low volume node-ish, got us to test this level here. Just don't think you should stay down here. Why didn't the bulls hedge? Why didn't they hedge as much as they usually do? Does it have something to do with the fact that commodities just went crazy today? Soy, oil moved a bit, wheat, corn. I mean, recently commodities have been moving because China had some issues, and so they were putting in big orders for our commodities, and that definitely bolstered soy. I don't know why soy. They must just really love soy down there or something. I don't know. I try not to eat soy. I think soy is terrible. Seems to make me sleepy. Might just be getting old, but I feel like soy makes me tired. So almost done. So I'm waiting right now. What I'm waiting for is for this to finish up, and then I'm going to be able to mark out. You know, we had our toothiness here. 2 positions get pushed down. That's going to pressure those bulls stops. We'll get a liquidity spot here to take a look at and see what they're going to do. This right here is essentially our origin for bears. I guess it was tough for the bears to hop in there. It's just the highest position for the day. So for the day, and definitely it's, you know, in this move, it's the highest spot. So if this were to become bearish, this absolutely is going to be the origin that they're going to be operating from. And by operating from, I mean you capture profits in there with positioning, and then you use those profits in the future to sort of leverage being able to add on and get into a bigger and bigger position without your risk increasing too much. So you operate from an origin in certain ways to do that. So this would become an origin. I still think that it is in the crosshairs of the bulls right now. But if into the close here, we can, if the bears decide to run another algo and they can get it, they need to get it down here under this. Then they're going to be feeling a lot better. I still think this is really risky for the bears. These guys are definitely trailblazers. Trailblazers are a group of people who come in and try and counter trend trade in the face of a trend, in the face of dominance and control. They're very difficult people to trade with, and I don't ever recommend it. Trailblazers are troublemakers. So these guys come in and they're doing the best they can. Not terribly bad at the, you know, down here at this point. But the trailblazers are high risk traders. So your risk is always going to be higher trading with trailblazers. You can always tell a trailblazer because their position would be considered an origin. They are trailblazing against whatever is going on. I don't like trailblazers. I like to be in the secondary, the, you know, further on once it's established and clear and we know what's happening. That's the position that I like to get in. So while it looks like, oh, they're doing so great, trying to trade with this group is going to be high risk because they're the first group to jump in. And while the profits tend to be significantly higher with trailblazers, and I mean like a lot of times like double or triple, your risk is also significantly higher because 10 times, you're going to take 10 times more losses. So it looks appealing because the vertical profits are really good. They, you know, your payout could be like 50 points. Woo, that's so great. But if you lose 10 times, you're going to be in the hole probably like 70 points. And so it's like, your vertical profits in terms of time look really nice. But over time, I think that being a trailblazer tends to have negative returns. I don't think it's an effective way to trade. Doable, I suppose, but terribly ineffective over the long term. The best types of trading that you can do is the pile in. You find your origins and then you try and You try and wait for moments when things look good, and you try and pile in, and then you take your you need huge account balance changing returns to survive. You can't take little tiny returns to really survive over the long term. You're going to need big pile wins, and institutions need it too. They're not looking for 5 points. And markets like this, they're not looking for 10. I used to look for 10. 10 was always the big square number, but these days it's like 50. They just aren't looking for 10 anymore because the volatility is so insane. But I think they hedge a lot of those 50 points into options these days. So it's not like they're really picking up 50, but they're looking for massive 50-point moves minimum, something like that. That's just what they do. It used to be 10. I swear last year it was 10. It was just always 10. You'd see it go, you'd have your reason to buy, it'd move up to 10 points, and then you'd always see this response. And it's like, why? It's just because it was 10. They were just looking for 10. There was no reason for it. Just nice square number to take profits and tell your buddies about. Okay, there are our buyers. I'm going to duplicate this. So that was our toothy pullback. It is done now because we have our bullish liquidity showed up right there. So now we can move the market up. I think the target here by the bulls needs to be up at least at the highs. We don't want to leave these bears in a positive position. We definitely don't want them to be hedging like this. What the heck? Letting them get into in-the-money calls against their put. So I think the objective here is to do that. Now, the reason that this is problematic is the same reason we talked about. It's because this position now is just a little bit hedged. So it's probably not 100%. It's probably like 20% risk neutral, but that's going to cause resistance. As we get there, the market's going to be more resistant to that push back up. And you're asking, well, why now? Well, we had our teeth, right? Had our teeth coming down. There's our bullish position. Why would this move up? We need to capture the cash used to make this. The algorithm cash needs to get captured into the close. We can't let them run an algo and then just pull the money out of the market for free. No. You put that money in. And the reason that you don't immediately pull the cash out is because if you just drop all that stuff immediately off, price will go whoop right back up, like just in a snap. And we see that. If you've ever watched a market that you're sitting there and it's like, and then it just tanks and then comes right back up like this, that's because somebody put algo cash in and immediately deleted the cash. So if you pull that right off the books, it immediately pops back up. And the problem ends up being a function of speed. As soon as it starts coming off, the market will outrun you. So what their hope is to push the market down, see some activity while they slowly pull orders off the book. And then once they're at $0 risk, then they can do something else. And then it can move back up and there's no risk. We need it to go whoop right back up and trap that cash in. And that cash can then get converted into moving the market up. So algorithms are a little bit funny. You have to sort of pick out what makes sense, what doesn't make sense, why you would do it, why wouldn't you, can it get rolled over, and who's going to roll that over. And I think in this market, pushing this down kind of did what we're looking for here is teeth. I still think this is in the crosshairs. Less so because of the little bit of a hedge. Not a huge hedge. Is that another one? Well, this one was here. I'm more concerned about this one because it's at a better price. They probably got their hedge lower than this one. But they're getting up to about the same, this is at what, 400? 400 contract hedge. This one right here is 550. Oh, that's not super different in terms of hedging. And I like to see that the highs on a day have no hedges. They just get an outright position and then the market can run them out. Unfortunately, if this market pushes up there, they're probably at a pretty decent percentage of their position hedged out. And that's not making me happy even a little. I don't like this. They're probably at 50 or 60, maybe 70% of that position hedged with those contracts. I bet we don't see this move up that much into the close. So if we hedge out both sides, that means we're going to have this upside here, downside here, with like a bullish bias. So if we just close this here, a lot of the buyers who are in this upper area, which a lot of people are going to be trying to buy into this pullback, they're going to get time trapped out. I bet a lot of people are here. I think a lot of people are here. I think a lot of people are trapped in longs in this range. So if we close the market, what will happen is it's going to push out everyone. Oh, and they're getting it lower. No. That, the drama increases. This is dramatic. We're down here. We're down to like this. 67. Now this is going to get interesting really quick. I'm going to mark this here. Now that was painful. If you were long, oh, your brains are scrambled right now. No. No. This is just favorable. We saw right here the bulls picking up their toothy market. Not much going on here, but it's into the close. And then a shot lower on these guys. This is going to get dramatic. I think tomorrow's going to have some really good drama going on. I think tomorrow's read, I'm going to do a morning read tomorrow because this market looks like the drama sort of tapered off and we're building this back in. I think tomorrow is going to be significantly more interesting than today, which today was, I don't know, I give today like like 35 out of 100 for complexity. For the morning, how it topped off, drove us down to here. It's this little move down here that I think has made this market much more interesting. It's two teeth. So we got a double tooth here. We got a burp, and then again. So I think tomorrow is going to be more interesting. I still don't think the bears have this yet. If they're going to get it, they will need to drive. We just put our head in a bear's head. They're going to need to drive both of these down under. Now remember that when we hit zero, both of these are going to create opportunities for the bulls to come in. So if they inject a ton of capital and just brute force this lower, okay, fine. But the next thing is tomorrow morning, we will immediately have bullish opportunities showing up. If like we gapped down, which I don't think a gap down. I think a gap up still makes sense here. They were able to drive this down to the root position this morning, and that's okay, sure, whatever. I would have liked the bounce here. It would have been a lot more structured, but I still am not bearish. I still think this needs to move up at least to the highs. Because tomorrow morning, if this gapped down, 30-minute tension would probably be here and immediately hit zero. Daily tension, probably here, hit zero. And the bulls would come right in the morning. Now, maybe they want to do that. I don't know. But in terms of possibility space, this would be a risky play for the bears unless there's some news event that everyone knows about that can back the move. I don't think this is a sustainable thing to do. I think tomorrow we'll be up maybe here, and I think probably overnight the ES is probably going to come back up and hit the highs at least. I don't think we're heading lower. I don't. I think this is just giving you a pain in the butt because it's a secondary and position off of a root, and they're just a pain in the butt. So hopefully you've used some insurance policies or trading options or just aware of it, and we're able to manage this in a way. I think that tonight is going to be the thing to look at.
Oh, you're not watching the TV?
Okay. There's not much else to say about that. We have pushed this down to the origin. I think tomorrow is going to be more interesting. We're going to pay attention to how we position in the morning, and I think it's going to have a lot to do with the way today works. Remember, this trade, that this move up, it started here. So it's not just today. This whole thing is just a continuation of this plunge here, testing that low. Should have hedged more. I think these guys should have done that. Man, this is rough stuff. Okay, 2 o'clock market. The ES and the stocks are shutting down, though a lot of people will continue to trade for a couple minutes. I anticipate this moving back up overnight, at least. And tomorrow we got to see a more interesting market. That was the algos that hit this were a lot more aggressive. I mean, that was some intense algos. Had my attention. You had my attention, but I still don't see it. If they had gotten this down through here, under here, right there, boop, 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 this would have really concerned me, because that meant they were going for that risk exposure, but they weren't able to pull that off during the day. And algos are significantly more difficult to run overnight because you can't manipulate all the stocks. They don't quote. So if you call up your buddies and you try to manipulate a stock together, let's say you decided to do that, which is illegal unless you don't get caught, then you might push all the stocks up, but they're not quoting, so nothing really happens until pre-market. And then you see this big old thing, and it's like, oh, you guys were doing something overnight. So it's harder to run algorithms during the overnight session. So overnight sessions tend to be what I feel like is more honest. They're less manipulated. And so they tend to do the things that you were looking at during the day a little bit better. So I have found there are huge chunks of time where I spend most of my time positioning during the overnight session, because it's just more honest. It just works out better. It's just how it is. Maybe you guys have found that, maybe not. So we had a pretty beefy algorithm right there into the close. I think that was a good sized algo after that, and it gave us 2 teeth, and it didn't overturn this, and it didn't get past here. So I'm still looking at this. Would I position here? No. In fact, I probably wouldn't have positioned anything today. Yesterday, yeah, I really like to try and position with origins, and I like to hold a little bit bigger these days because I think that's the objective of the institutions. I wouldn't have done much with today. You could have. I don't know. I'm a little bit more hands-off these days. Okay, so those are my thoughts. Take what you want. I'd love to hear you guys' comments in the Discord if you're in there. I do read all the comments, and yes, I'm always at my computer. I just don't always have stuff to say. I think this is going to be more interesting tomorrow, so I think being here at the open, or at least keeping up to date, I'm going to get up and tomorrow morning be looking at this. I think the drama should be just excellent. We see this kind of stuff go on right into the close. We get nice, fun drama. And by drama, I mean the old bait and switch, lying to people, backstabbing. You'll see it. It's a lot of fun. My favorite markets to trade are dramatic ones. The reason is because drama is very easy for human beings, and it is very difficult for algorithms. You can extract the drama of an institution doing this and that and the backstabbing nature of it, where algorithms have a hard time with that type of applying an attitude to something. But when you see it, you know it. And those are my favorite because they tend to pay out better because they're tough for algos to pick out. And they're more fun. I think they're significantly more fun to read. They keep you on the edge of your seat. And I'll be here to watch the old TV of InEquity play out right in front of our faces and see if I can take advantage of some of the opportunities. So if you guys have comments, put them in the Discord. I will read them and comment if I think they're awesome, or maybe even not. I'll still comment. All right. See you guys tomorrow.